After stunning the markets in April this year, the Bank of Japan held pat on policy for its second straight meeting and refrained from revising up its economic outlook. Joining me on the phone to share his perspective is Commerzbank's Marco Wagner. Marco, the central bank did sound more positive on inflation, saying inflation expectations appear to be rising on the whole. Looking ahead, the BOJ expects year-on-year CPI growth rate as rising gradually. But do the fundamentals back these statements, in your opinion?
It is true that the inflation expectations seem to have increased on the whole. However, the hard data do not back the perceptions. The year-on-year increase in the headline inflation rate, which we have seen in June, was mainly due to a surge in the energy prices. By contrast, the core inflation rate, excluding energy and food prices, still declined at a rate of minus 0.3%.
Kuroda also issued a strong warning against easing up on fiscal discipline, stressing that the country can raise sales tax and still keep the economy strong enough to put an end to grinding inflation. What is your take on the suggested two-stage tax hike?
First of all, I think that the tax hike is absolutely necessary. It is a crucial step to contain the government deficits. And second, I also clearly agree with the BOJ governor, as I am also convinced that the rise in the sales tax should not kill the ongoing recovery. This can also be seen from past experiences. While the households consumed more in advance of such a tax hike, they consumed less right after the tax hike. But as soon as half a year later, the private consumption was back on its normal level already.
The Bank of Japan will have more indicators to gauge the strength of the economy next week, with Monday's release of second quarter GDP data and Tuesday's manufacturing orders for June. What are you expecting from these?
For next week, I expect really good figures, which will show that the Japanese economy is on a solid recovery track. In concrete numbers, GDP should have grown in the second quarter by almost 1% over the first quarter, mainly driven by exports, but also the households should have robustly raised their consumption demands. Machinery orders, however, should have declined a little bit in June, but this still makes a higher second quarter compared to the first quarter, so there are also positive signals from this indicator.
Having been unable to settle above the 100 mark, some analysts are forecasting a range of around 95 to 102 for the dollar-yen. Is this in line with your outlook, and do you think this is a figure that the BOJ will be comfortable with, given its deliberate currency depreciation streak?
This range is a little bit too conservative for us. We see the yen against the US dollar at a level of about 115 towards the end of the year. And the reason is that I do not believe in the third era of Abenomics. This is to say, I do not think that Prime Minister Abe will implement wide-ranging structural reforms which are so urgently needed, particularly on the inflexible labor market. So this will make the current recovery a flash in the pan and soon bring the economy back to its medium-term growth path, which is clearly below 1%, and this will finally bring investors back down to reality.
Marco, it's been a pleasure speaking to you once again. Well, viewers, that's all from me at the moment, but click back to the site for today's Commodities Corner and Press Review. But for now, goodbye.